Hi, welcome to CITG Accounting and Finance. My name is Shadrach Opoku Frimpong, and we'll be looking at capital budgeting. So, capital budgeting, which is also known as investment appraisal, is a long-term financial planning process that helps companies to decide which project to invest in to increase their value. It is basically the process by which business evaluates and decide on significant long-term project to undertake. These projects could include the purchasing of machinery, building facilities, launching new products, or even entering the new market. And the whole goal of this capital budgeting is to determine whether these investments will generate sufficient returns to justify their initial cost. So take it this way. As a business, we have a lot of investment opportunities made available to us. However, they may not all yield the same returns, right? So capital budgeting is just about evaluating these investment opportunities and looking at the returns that they are going to yield and strategically choosing the investment project or investment opportunity based on its earnings. So let's look at some of the importance of capital budgeting. So one, long-term success. So capital budgeting decision impacts the long-term financial health and growth of the organization. So capital budgeting is long-term oriented in the sense that we are undertaking a long-term investment project and we are looking at the returns that we will be yielding or we will be generating from that particular investment in the long run or in the long term. So there is nothing wrong when we are making losses even at the beginning of the project, because the main aim of capital budgeting is to make some returns at a long term. Two, resource allocation. So capital budgeting ensures that limited financial resources are allocated to the most profitable and strategically aligned projects. So as I said, we may have a lot of investment opportunity made available to us. So we can have investment A, B, C, and D. However, we may not have the financial resources to undertake all these investment projects. So capital budgeting is going to help us to determine which of this project is more profitable. Then we allocate our financial resource to such an investment. Three, risk management. So capital budget evaluates the potential risks and uncertainties associated with these investments, helping organizations to make more informed decisions. Every company may have their own risk appetite or risk tolerance, and every investment, of course, has some level of risk. So with the help of capital budgeting, it's going to inform management or the organization that these are the risks involved in this investment opportunity. If per the company's risk management policy or framework, they can go ahead and undertake such an investment, they will go ahead. If it is too high for them, then they may get the option of what? Pulling out. For maximizing shareholders' value. Now, by choosing the most profitable project, businesses can enhance shareholders' worth and ensure sustainable growth. So take it or leave it, the main financial objective of every business is to maximize its shareholders' value. Now, maximizing of shareholders' value comes by way of what? Share price appreciation. Share price appreciation. And dividend. So if you want to increase the value of shareholders, pay them reasonable dividend, and also there should be an increase in the value of their share price. Okay. The last one, cash flow management. So with the help of capital budgeting, we can analyze how investment will impact our future cash flows, ensuring financial stability. So when we use this capital budgeting techniques, we may be able to predict how funds will be received or funds will leave the organization in the long term, depending on the span or the life of the investment project we are undertaking. So there are some few methods of capital budgeting, and let's look at them. So first, we have the payback period. We have the accounting rate of returns. We have the net present value. We have the internal rate of returns, and we have the profitability index. So let's look at the payback period. So the payback period is the time required to recover the initial investment in a project. So the focus here should be recover initial investment. It is one of the non-discounted cash flow methods of capital budgeting. We will understand this when we start doing some computations. The payback period of an investment project tells us the number of years required to recover our initial cash flow or our initial cash investment based on the project's expected cash flows. The emphasis or the key takeaway when it comes to the payback period is the recovery of the initial investment in the project. Here's the catch. We may have an investment opportunity that will require, let's say, $100,000, right? And the investment may give us an inflow or generate an inflow of, let's say, 50,000 in the first year. So year one, year two, 70,000, year three, 100,000, year four, 20,000. This should be project one. Then we have project two. So project two will give us 80,000, or let me say 100,000 rather. Then we have 30,000. Then there is nothing subsequently, right? So when it comes to the payback period, the focus here is which of these two investment projects is going to give us or is going to help us recoup or recover our initial investment of 100,000. Both investment projects, we are going to get our money back, but which one is going to pay us as early as possible? Which of these two projects are we going to recoup our initial outlay or our initial investment of 100,000 as early as possible? You can see project one, we will be recouping our funds somewhere in year two, right? Year one, we are going to receive an amount of 50,000. Year two, you are going to receive an amount of 70,000. So in between year one and year two, we are going to recoup our 100,000. But when it comes to project B, in the first year, we are going to recoup everything. So if you are using the payback period, then our advice to management will be that we should go in for project two, because project two is going to pay us our initial investment as early as possible, right? So there is a little bit of disadvantage here. The focus is when are we recouping our money, and it doesn't consider the cash flows or the inflows after we have recouped our money. So ideally, when we look at project two, we are going to receive a total of 130,000, whilst we will be receiving an amount of 50, 70, that's 120, 220, and 240. So with project one, you are going to receive about 240,000, but with project two, you are going to receive an amount of 30,000. However, because project two is going to pay us early, we are going to select project two. So we are going to ignore cash flows after the payback period. And that is one of the disadvantages that comes with using the payback period. So let's look at the merits and demerits. So it is easy to calculate and simple to understand. The payback method provides further improvement over the accounting rate of returns. 3, the payback method reduces the possibility of loss on account. So, of course, because our concern is on the investment project that is going to pay us early, and the chances of losing our funds is very, very low. Let's look at the demerits. 1, it ignores the time value of money. So we are working with future cash flows. We are working with projections, and we are making our analysis now. So all things being equal, we are expected to discount these future cash flows to present values. However, the payback period tends to ignore time value of money. So the figures are not going to be discounted. They will be kept in present value, and we will make our decisions with it. It ignores all the cash flows or cash inflows after the payback period. So just as I illustrated, and it is one of the misleading evaluation of capital budgeting. We said the main purpose of capital budgeting is to evaluate investment projects and also select the one that is mostly profitable. So then if you are using the payback period where the focus is on where we are getting our money, and it's going to ignore the inflows after the payback period, it might not really show the profitability position of the investment project we are undertaking. Now, if you analyze or evaluate an investment project, your advice as a finance director or the finance person in the organization will either be to accept the investment project or to reject the project. Now, your decision should be based on the actual payback period, which is being less as compared to the predetermined payback period. Some organizations have a predetermined payback period as part of their policy. So there are instances the company will be telling you, for us, we don't undertake any investment project that has a payback period of more than 3 years. So indirectly, they are telling you that if you do your analysis and the payback period is more than 3 years, we are not going to accept such an investment project. So basically, we are just going to reject the project. So you as the finance director, the finance person, after you are done with your computation, you have to recommend, and that is what comes in the exams. The examiner will ask you that recommend to management whether the investment should be undertaken or it should be rejected. In a case whereby they don't give you the predetermined payback period of the organization, they may give you 2 or more investment opportunities. So if you are using the payback period, then you are going to suggest to management the investment project that has a less payback period. So I have an example here that we can look at it. Suppose that we wish to determine the payback period for a new flaking facility. We determined at the time that for an initial cash outlay of $100,000, expected net cash flow of 34,432, 39,530,000, 39,59, and 32,219 over the next 4 years. So the requirement is for you to determine the payback period of this investment project. So we are in year one. Oh, sorry, we are in year zero. Always year zero is the year in which we are going to incur or undertake this investment project. So year one is going to be our first inflow, year two, year three, year four. Now, year zero, we have incurred an amount of $100,000 and we are expected to recoup our funds. By year one, we were paid $34,432. Year two, we received an amount of $39,530. So year one, year two combined gives us $73,962. That's year two. So we have to receive funds in year three as well. So year three, we received 39,359, right? And combining year three's cash flow to year two and year one, it gives us a total of 113,321. Now we are interested in the exact date we were able to recoup our funds, right? So what we are going to do, we are going to assume that cash flow was received evenly throughout the year. So what it means is that this 39,000 was received in tranches or was received month by month, and we received the same amount every month. So if you want to know how much we received each month, it's going to be by 12. Right. But the key takeaway is that year one, year two, we've received an amount of 73,962. So what is going to be the difference the difference between what we've received and what we have invested. So we will have $100,000 minus 73,962. So let's do the math. Okay, so this gives us 26,038. So this is what we have left to receive. So as at year 2, we have received this, and we have 26,000 more to receive. So in year 3, we received an amount of 39,000. Right. So what we are going to do is to divide this 26,000 by the amount that was received, 39, times 12 months, so that we can know the exact month in which we received the funds. 7.9, so it's a month, so it's going to be like 8 months. 8 months. So it's going to be the 8th month of the 3rd year. So we have 2 years already, plus the 8th month of the 3rd year. So in all, it took us 2 years, 8 months, 2 years. Pardon me, 2 years, 8 months to recoup our funds. Let's look at accounting rate of return. So accounting rate of return, or average rate of return, is the average return or profit taken for considering the project evaluation. And this method is one of the traditional methods for evaluating the project proposal. So with this, we are looking at accounting profit. So you are going to find the average of the profit that has been made so far from the project. Then we will divide it over the initial investment, how much we spent on undertaking the investment project. So let's look at some of the merit and demerit. So it is easy to calculate and simple to understand. It is based on accounting information rather than cash flow. So accounting profit is different from cash flow. The profit which is being reported by the accountant includes provisions, depreciation, and all those things, right? Which some of them are not cash flows. Demerit. So it ignores the time value of money, and also different methods are used for accounting profit. So it leads to some difficulties in calculation of what the project. There are a whole lot of assumptions that the accountant makes when it comes to preparing the financial statement and ascertaining business profit. Some may use straight line method, some may use reducing balance method. When it comes to inventory, some may use FIFO, some may use LIFO, some may use weighted average. So there are a whole lot of different methods which is being used when it comes to determining accounting profit. Okay. When it comes to the acceptance or rejection criteria, you're saying that if the actual accounting rate of return is more than the predetermined required rate of return, then the project would be accepted. If not, the project would be rejected. So with this, the business or the company may have their own predetermined rate of return. So you hear stuff like, for us, we don't undertake any investment project that's going to pay us less than 20% or less than 10%, less than 30%. So if they have a predetermined rate of, let's say, 10%, then after you are done with your evaluation, your analysis, and you are getting a rate of 15%, then it means it is profitable. So you should go ahead and pay. Now, what happens is that before they come up with this 10%, they would also do their own computation. That's from the business side. They would have their cost of capital and know how much they are supposed to pay to shareholders and bondholders. So if the cost of capital is, let's say, 10%, they want to undertake investment projects that will pay them more than what is required of them to pay to their bondholders and shareholders. So if it is 10%, then investment project that pays 10% and above should be what considered. Now we have this question. So the cost of machine, we have the automatic and the ordinary. The cost of machine is 220,000 and we have 60,000. Estimated life is 5.5, and this 8 years. Estimated sales is 150, 150. Material cost is going to be 50, 50. Labor is going to be 12,000. There's going to be 60,000. Then variable overheads, we have 24,000 and we have 20,000. So compute the profitability of the proposal under the return on investment method. So this is what we are going to do. We are going to determine profit, right? Initially, we have the cost of the machine. We have the useful life. So that is going to help us when we are computing depreciation. So estimated sales, that is going to be 150, 150. It's given to us in the question. Then expenses, we have the material, we have labor, we have variable overheads, right? Then we compute depreciation. So if you want to know the depreciation, it's going to be 220 for automatic divided by 5.5. Then ordinary is going to be 60 over 8 years. And if you have to do the computation, 40,000 and we have 70,000. So 126,000 is our total cost when it comes to automatic, and 137,000 is going to be our total cost under the ordinary project. So we now deduct it from our sales and we arrive at our profit, which is 24,000 and 12,000. Now looking at it, you may think automatic has a profit of 24,000, so you may think automatic is more profitable, right? Then ordinary has 12,500, so ordinary is less profitable. But let us determine our rate of return. Then we will be able to tell which one is more profitable than the other. So these are the workings that I did in terms of depreciation. Now, if you are to determine the rate of investment or rate of returns on the investment, we have 24,000 on 220,000. This is the cost of the machine or the outlay or the outflow. Then we have 12,500 profits from ordinary. This profit from automatic, profit from ordinary. Then you realize that when we computed the rate of return, this, which had a profit of 24,000, is giving us a return of 10.9. How's this one that gave us a return of 12,500 is giving us a rate of 28%. You know why? The difference is coming from the outlay, right? We are spending 220,000 to get a profit of 24,000. How's this one? We are spending an amount of 60,000 to generate a profit of 12,000. So in effect, the ordinary is more profitable than the automatic. So when you look at it on the basis of the profit, then automatic is more profitable. But if you are looking at it from the basis of returns on investment, then the ordinary is more profitable. Okay, let's look at the net present value, NPV. So the NPV method is one of the modern methods for evaluating project proposal. In this method, cash flows are considered with time value of money. So when under this method, we consider the time value of money. 1 cedi today is not the same as 1 cedi tomorrow. What 1 cedi can buy today, 1 cedi cannot buy the same thing tomorrow. It may probably move to 1.5 or 2 cedi. So we have to consider all those in our analysis. So net present value describes as the summation of the present values of cash inflow and present value of cash outflow. So we look at inflow, what is coming in, what is going out, and probably these are all future cash flow. So we get them in today's terms, then we sum them together. So net present value is the difference between the total present value of future inflows and total present value of what? Future cash outflows. Now, when it comes to the merit, it's recognized time value of money, and this the disadvantage of the earlier methods. right? But it's an advantage here because it considers time value of money. So it considers the total benefit arising out of the proposal. So unlike the payback period, where we don't consider cash flow after the payback period, this one actually considers everything. 3, it is the best method for the selection of mutually exclusive projects. And 4, it helps to achieve the maximization of what shareholders worth. Take it or leave it, this is one of the best methods. And this is one of the most examined method because it is more practical, and this is one of the things you will be doing as a finance director or a finance person in an organization. Let's look at the demerit. 1, it is difficult to understand and calculate. So unlike the payback period, you just look at the payback period or the day in which we are going to recoup our money. This one, you have to determine the future cash flows, determine the rate of return, discount them, determine the present value, you get to the net pay. It's a whole lot, right? But to me, I don't really think it is difficult to understand and calculate. But as compared to the traditional ones, this is a little bit complex. 2, it needs a discount factor for calculation of present values. The figures will be given to you in their future values, and you have to convert them to today's value. That's the present values because we are making our decisions now. So you need a discount factor to be discounting all the present values to be discounting all the future values to present values. 3, it is not suitable for projects having different effective lives. So if you are making comparison among projects and this project have different investments and this project have different lives, then it is not suitable because it considers the lifespan and the cash flows that will be received during each year. So if it is not the same, then this is not the best method. So acceptance and rejection criteria. So if the present value of the cash flow is more than the present value of the cash outflow, then it should be accepted. If not, it should be rejected. So at the end of the day, if your total figure is positive, let's just use this, it's positive, then the project should be accepted because we are going to sum our outflow together with our inflow. So if our inflow is more than the outflow, we are making profit. So it's going to be a positive figure, right? We are making profit, so the project should be undertaken. But if our outflow is more than our inflow, it's going to be negative. So the project should be rejected, and management should not undertake such a project. So I have a question here. Let's just try our hands on it. So calculate the net present value of 2 projects and suggest which of the 2 projects should be accepted. So we have project X, we have project Y. The initial investment is 20,000 and this 30,000. So under project X, we need 20,000. Project Y, we need 30,000 to undertake the project. The estimated life is 5 years and 5 years. Now the scrap value of each project is 10,000 and 20,000. So if it's an asset or machine, after the useful life, after the 5 years, we will dispose it off or we are going to sell it, right? And this is the amount we expect to get from its disposal. So the profit before depreciation and after taxation are as follows. So year 1, year 2, year 3, year 4, year 5. So project X will be receiving 5,000, 10,000, 10,000, 3,000, 2,000. Project Y will be receiving 20,000, 10,000, 5,000, 3,000, and 2,000. Note, the following are the present value factor at what 10%. So this is the discounting factor, and the examiner was kind to do the computation for us. So this is how we go about it. So we have the relevant years, we have the project X, project Y, then we have the discount factor. So what we are going to do, so these are future values, okay? These are future values, these are future values. So what we are going to do is to convert these future values to present values, PVs. So PVs, so future values, future values. So we are going to multiply the future value with the discount factor to get the present value. So what it means is 5,000 in year 1 or in a year's time is equivalent to 4,545 today. 20,000 in a year's time is equivalent to 18,180 today, right? So we apply the discount factor against the future cash flow. Then we arrive at our present values. Now, after we are done with the relevant cash flows for the 5 years, we bring in the scrap value, what we will be getting from the disposal of the asset or the project. Now, the scrap value for project X is 1,000, then project Y is 2,000. But after applying the discount factor, you realize that we are receiving 621 and 1,240. And we said scrap value, the asset is being disposed of after its useful life, so after 5 years. So it means that 1,000 cedis in 5 years' time is equivalent to 621 cedis today. Then 2,000 cedis in 5 years' time is equivalent to 1,245 cedis today. So we add all these inflows, add all these, and we get the total. So the total is the present value. So we have 24,000 for project X. We have 34,000 for project Y. Now we are going to deduct our outflow, right? All the time we undertake the project in year 0. So in year 0, the initial investment is not going to be discounted. Or even if it's going to be discounted, we are going to use year 0. And any figure exponent 0 is 1. So we multiply the initial outlay or the investment times 1, and it's still going to be the same figure, right? So we deduct this 20,000 from this 24,000, and we arrive at a net present value of 4,227 for project X. Then project Y, we arrive at 4,728. So between these two projects, they are both positive, and these two projects should be undertaken. However, if you have to select one, we would choose project Y because it gives us a higher return. Okay, so let's move on to the next one, internal rate of return. So basically, internal rate of return is the rate at which our NPV or our discounted cash flow will be equal to 0. So the NPV that we had, we use the rate of what? 10%. So IRR, which is the internal rate of return, is the rate that is going to give us a net present value of what? Of 0. Now, there is a formula for computing or arriving at your internal rate of return. And the formula is the base factor plus the positive net present value over the difference between the positive and negative net present value times your DP, which is the difference in percentage. So if we are to express it in real formula terms, it's going to be A, which is in percentage, your base factor, plus NPV of A and NPV of B. Then B and A, the difference between B and A. So this is what happens in the exam. So they are going to give you a similar question or a question like this, but they may not give you that of 2 projects. They'll just give you 1 project and they'll give you 1 discount factor. So you may have to come up with another discount factor, which you have to choose randomly, but it shouldn't be the same. It can be higher or it can be lower. The takeaway here is that if it is higher, then it may lead to a negative NPV. This is 10% and we are having positive. If it is 20%, then it may lead to a negative net present value rather than a positive present value. So you can come up with a rate, let's say 20%. You can come up with a rate, let's say 20%, and use that to compute a new net present value. Okay, so if you are to use this, let us ignore project X. For now, let us ignore project X. So we have this, then we come up with a new rate of 20%. So 20%, right? So we are going to inculcate this 20% in our formula. So this is our discounting formula. All right. So instead of using 10%, we are going to use 20% for our computation. So for our discount factor, we have 1 plus R, which is 20% minus 1. Then we have 0.833. Year 2 is going to be 0.694. Then we have that of year 3, which is 0.579. Then year 4 will be 0.482. Then year 5 is going to be 0.402. And for scrap value, it is also year 5, so 0.402. So now let us multiply it with our future cash flows and let's see the results. So we have 5,000 times 0.3833, and that gives us 4165. We have 10,000 times 0.694. That gives us 6940. This one gives us 5710. Then year 4 gives us 1446. Year 5 gives us 402, 804, and the scrap value gives us 402. So if we are to add everything together, that would give us 19,467. Now this is our present value. So if you are to deduct our initial outlay of 20,000, it means you'll be getting negative. So we have a negative NPV. So permit me to write here, a negative NPV of 533. So you see the effect. If the rate is being increased, then the chances of getting a negative NPV is very high. So when it comes to internal rate of returns, once again, the examiner will give you one rate, then you would randomly select another rate. But most likely, the one that the examiner is going to give you might result in a positive NPV. So if you are choosing, you may choose a higher rate so that you can get a negative figure. Then you now slot it in your IRR formula. So the A here, or the base factor, is your positive NPV rate. So that's 10%, right? Plus the NPV of A. So the NPV of A is 4,227,000. So we just move on to 4,000. So this is 4,227 all over 4,227 minus our NPV of B, which is the other one that we computed. And that is also a negative figure. So it's going to be minus, which will turn out to be positive. So 533, right? Times B is the new rate we used to arrive at our NPV of B, which is the 20% that was used, minus A, which is 10%, right? So it's going to give us the difference of what? 10%. So it should be in brackets. So if you are to do this, your IRR would result in 0.1888. So if you are to express it in percentage, and please, at every point in time when you are being required to compute your internal rate of return, make sure you leave your answer in percentage terms. So that should be 18.88%. So what it means is that if you are to use 18.88%, then our NPV is going to be 0. And you can see that when we used 20%, we had negative 533. So 18.88 it makes sense, it's close. Meaning if you have to use 18.88, we wouldn't get any positive figure, we wouldn't get any negative figure. We will get a straight 0. Now let's look at the merits and demerits of internal rates of returns. So it's consider the time value of money. One, it takes into account the total cash inflow. So it basically just like the net present value. It does not use the concept of what the required rate of return. It gives an approximate or nearest what rate of return. So the 18.88 is the nearest. It might not be the exact. You may, when you use it, you may get some small figures or small balances because yeah, there is an approximation and all those things in there. When it comes to the demerit, it involves complicated computational methods. So you could see the computations with it. 2, it produces multiple rates, which may be confusing for taking decisions. So you have to come up with another rate. The examiner gave you 10%, you have to come up with another one. So that is a demerit because now you are having two different rates that you are using for your computations. 3, it assumes that all intermediate cash flows are reinvested at the internal rate of returns. So acceptance and rejection criteria, if the present value of the sum total of the compounded reinvested cash inflow is greater than the present value of the outflow, then the proposed project is accepted. If not, it should be rejected. So I have a step-by-step guide here. If you want to do the internal rate of return or compute your internal rate of return, the step-by-step guide that you should follow if you didn't get it when I was doing the computation. I also have a question here. So let's look at the question. So a company is trying to decide whether to buy a machine for 80,000, which will save cost of 20,000 per annum for 5 years, and which will require or have a resale value of $10,000 at the end of year 5. If the company's policy is to undertake projects only if they are expected to yield a discount factor return of 10% or more, ascertain whether the project will be undertaken or not. So let me say this. So anytime it comes to internal questions relating to internal rate of return, you first have to compute your net present value. Then you go ahead to do your internal rate of return. So this is the company's rate of return, predetermined rate of return. They don't undertake investment projects which is less than 10%. So if you come up with a rate and it's less than 10%, then I'm sorry, the company will not be interested in investing in such a project. So this is what you are going to do. You are going to determine the present value using the 10% that was given to you by the examiner. So the inflow is going to be 20,000. And here what they did was they used the annuity formula, right? If you think you are going to get it confused, you have to stick by laying out the years individually. So year 1, year 2, year 3. But what they did was to use the annuity formula. So they did year 1 to year 5. And we are going to receive 20,000 each. So they go to the annuity factor, then they apply the annuity factor, and that gave them the 75,820. Then they did the scrap value, also got the amount, and they determined their end PV. The annuity formula is 1 minus bracket open 1 plus R, so bracket exponent minus N all over R. Right. So if you think this one is going to be difficult, you just have to do your year 0, year 1, year 2, year 3. Then you use your discount factor. And you still arrive at the same amount. So our net present value is 2,030 when we use the rate of what? 10%. Now we have decided to use a rate which is higher than the 10%. So we are using 12. Realize our net present value is what? Negative 2,230. Then we populate it in our IRR formula. So we are getting a rate of 10.9 or let's say 11%. So if the company's policy is to undertake an investment project that yields more than 10%, and this is 11, then what we are going to suggest to management is that they should undertake the project. So thank you for your time, and we will meet subsequently.